Thank you very much for joining us here this evening. You're watching News Now and I'm Nivedna Prabhu. Let's put the top focus on the fact that S&P Global has upgraded India's long-term unsolicited sovereign credit ratings to BBB from BBB. It has cited economic resilience and sustained fiscal consolidation while maintaining a stable outlook. In fact, the agency said the stable outlook reflects expectations of continued policy stability and high infrastructure investment. In fact, this upgradation, remember, comes amid US President Donald Trump's dead economy jab that we all remember, and S&P also said that the impact of US tariffs in India will likely be manageable, with sound economic fundamentals expected to support the country's growth momentum over the next 2 to 3 years. As far as this is concerned, my colleague Ankur Mishra had the opportunity to be in conversation with S&P Global Director Yeefarn Phua. This is an exclusive conversation. Let's listen in to the same.
India's sovereign credit profile has received a major boost after S&P Global Ratings has upgraded India to BBB from BBB-. To discuss about this, I have with me Yeefarn Phua from S&P Global Ratings. Mr. Phua, welcome to ET Now. My first question to you is, it has taken over a decade for this kind of ratings upgrade for S&P. Why it took so long, and what is the great thing which you are seeing in India currently which has actually compelled you to do this upgrade?
Thanks for inviting me today. Yeah, so if we look at India's rating trajectory, right? I think as you rightly pointed out, we last upgraded them to investment grade back in 2007, and since then there's been a few outlook change here and there. This is the first rating the actual first rating upgrade of India in 18 years. It's really a recognition of what the government has been doing, for the past 7 to 8 years, right? Especially in terms of how this government has been very proactive into driving economic reforms. At the same time, tilting budgetary spend towards infrastructure investment. We're also seeing that it has also helped to lead India into a growth story that has gotten stronger. And the last point also that we recognize as a key factor in the ratings upgrade was also the improving monetary policy environment. In the last 1 year or so, in fact, the last few years, we have seen inflation being a lot lower than before. Right, so these are all key factors that we are seeing that helps to combine to bring about a new trajectory in the credit metrics that we believe will improve going forward.
Right, S&P has called this a rare sovereign upgrade. How exceptional is this move for the major emerging markets, and how do you put India in that map?
First, maybe I'll just focus on the major economies that we have in the region, right? So this upgrade will now put India at the same rating level as Indonesia. At the same time, if we look at the overall the overall sovereign ratings that we have in the region, we also have the Philippines at BBB+, similar rating category with a positive outlook. We also, we look at other sovereigns in the Asia Pacific regions with a positive outlook. We also have Mongolia as well, due to commodity boom and over there and increased exports towards China. So if you look at the Asia Pacific region, there has been quite a bit of a positive rating movement, largely because we recognize the fact that the Asia Pac region as a whole has been doing quite well. Growth has been robust, inflation has been kept fairly under control, and a lot of these economies have embarked on very strong economic reforms, and that's the reason why, despite the fact that we see some external noises, we have some geopolitical tensions, and with all the trade tariff situation, the metrics in the Asia Pacific region, by and large, a lot of the sovereigns have strong metrics to withstand all this turbulence.
Right. Let's also talk about the growth front. While for the current fiscal you have projected 6.5%, but if you talk about 3 years, you have given an average of 6.8% for the next 3 years. What has been reason for the same? You think in next 2 years or 3 years, 7+% growth will be there for India's GDP?
Yeah, that's a good point that you just raised. Um, if you look at the grand scheme of thing, if you were to take India's growth number and give it to any other major economy, they will gladly take it. Right? This is a very high number by any standards. I think India is probably the highest growth, fastest growing major economy right now, right? So whether you can get even higher, we have to take into account the fact that if GDP growth is very high, but yet the things on the ground are not able to absorb it, you might end up with an overheating situation as well, right? For example, after the pandemic, India grew very fast, 8.8% on average, 9+% in some years for 3 years running. That level of growth could be unsustainable if it keeps growing like that, because it could create overheating issues in the economy. You could have credit bust and so forth. But if you look at India's growth, 6.57% is very comfortable for India, right? That's the reason why one of the factors we talk about the upgrade was also the increased focus on infrastructure spending by the government, because as your connectivity on the ground gets better, as infrastructure gets better, the economy is able to also then support a higher level of growth as well without overheating. So I think that's something that we're watching out for. That's something that we believe in, and that's why we, move the ratings up today as well.
Mr. Phua, the report also cites India's robust domestic demand. Now, that is something which has been washed out for many quarters, especially in India. What is your ground assessment on that front?
Yeah, for us, I think we tend to take a longer term view at this sort of things, right? If you look at India's growth, almost about 60 or 60-ish% is driven by domestic consumption. Yes, granted, urban growth has been a bit slower of late, but we still, as a whole, the numbers is still quite strong, right? That's the reason why we're still forecasting 6.5% for this year, next year 6.7%, and I believe the outer year will be 7%. So all in still a very healthy level of growth driven by domestic consumption. At the same time, if you look at net FDI numbers, even though on a net basis the inflow looks to be low than before, but actually gross inflows of FDI actually is quite strong. In fact, comparable to the last few years, we still see investments, coming into sectors like financial services, into consulting, into IT. A lot of industries are actually getting a lot of attention from foreign investors coming into India to invest in it, not because they think that this is a place for exports only, but also because of the fact that this is a place whereby you have a very large and growing middle income, a very large population, and people are coming in for that reason as well, to take advantage of that population dividend that you have.
Right. One of the other points which has been debated in the recent past has been private sector participation and the capex. Do you think that participation is anticipated in your report in next 2 to 3 years?
Yeah, I think in the next 2-3 years, if you talk about infrastructure investment, I believe a large part of it will still be anchored by the government, by the public sector, right? Not just central government, but also the states as spending a lot of infrastructure as well. So by and large, on those parts, I think the government will still be a very big component of it. But of course, private sector investment is strong in certain sectors, for example, renewables, toll roads, and so forth. So there will be some private sector investments into infrastructure as well. But because of the size of the government and how much money they're putting into it, this I think will still be the main anchor for infrastructure investment going forward.
Right. One of the points which has been mentioned in the report is general government deficit to narrow from 7.3% of GDP in FY26 to 6.6% in FY29. What is your roadmap for that? Is this achievable without compromising growth?
Yeah, I mean, you raise a very good point here. You know, the the wide deficits and the high level of spending also means that the government spending has quite a lot of fiscal and economic impulse and stimulus to it. So that's the reason why, even though we believe that fiscal consolidation is there, but it's happening on a gradual pace. You know, if you look at the makeup of the deficit, central is about 4-ish%. State deficits is still fairly high, about 3%, right? So if you look at the last few years, the consolidation actually has been more on the central side. The central has came down very quickly in terms of consolidation, while the state governments, will take a bit longer. And that's the reason when you add these two up, overall, the pace of decline in government deficit to GDP will be quite gradual, largely because the state governments, I think, will still have some things to sort out before they're able to cut down on their spending.
Right. The report also highlights RBI's monetary policy reforms, and that too for anchoring inflation expectations. We have seen consistently that inflation is coming well below the comfort level of Reserve Bank of India. Have these reforms fundamentally changed inflation dynamics according to you, or more importantly, do you think the elephant is out of the room as far as inflation is concerned?
Yeah, I think that's one of the factors that we were looking at as well when we were considering the upgrade, which is an improved monetary policy environment. Ever since the RBI switched to an inflation targeting model back in 2015, I think that new framework has certainly reaped dividends for the RBI. The inflation is a lot lower than before. I mean, if you compare to CPI growth numbers, just over more than a decade ago, there were quite a few times where it even hit double digits, right? But of late, we have seen it come down comfortably to about 5% or even lower. But you're absolutely right that recent figure shows that is almost undershooting the range of the RBI. But I think that's probably a more temporary situation because of you have food disinflation this year. Vegetable prices are coming down very quickly. But, core inflation actually is still about 4%, I believe. But all in, the environment is still very conducive in terms of monetary policy, in terms of strengthening transmission mechanism from the RBI.
Right. So what are the parameters? What could trigger a return to BBB minus or even lower? I have to ask this question because that is a point which has been mentioned in your report.
Yes, I think that the report clearly states also what was an outlook statement for the upside, also on the downside. For us, if we start to see that the government is abandoning fiscal consolidation, I think that will be a sign that the political commitment to push through reforms is being eroded, and that could result in downward rating pressure. At the same time, not just deficits widening a lot further, but also if deficits were to widen for just 1-2 years because of a need to support the economy, because of a need of an extraordinary crisis, I think these are things that we usually will be take a more nuanced view to, right? That we believe that ultimately it will come back, right? But if the deficits were to be prolonged, and it's proven that they will not want to keep public finances sustainable, I think that could be also downward pressure on the rating as well.
And conversely, when can we see the upgrade?
Yeah. So conversely as well, if you look at the upside the upside triggers for us for the next rating level is also based on fiscal consolidation as well, for it to come down quicker, and perhaps even beyond the forecast horizons. If the deficit to GDP can go down to below 6% on a structural basis, I think that also will create some upward pressure for the rating to go up. So when I mean 6%, I'm talking about general government, which is central plus the states.
Right. Last but not the least, I want to understand from you the tariff scenario. You mentioned in the report, even if 50% tariff is levied on India, there will not be much impact. What is your assumption? How much do you think growth will be hampered on 50% tariffs? And overall, what is your assessment of tariff scenario impact on India?
Yeah, to be honest, if you look at the overall tariff situation, it's still an evolving and fast-moving story. But ultimately, we don't think it will hit India's economic growth that badly. That's the reason why we say it's manageable, right? If you look at India's exports to the US in terms of GDP, is about 2% or so, not very high. But once you factor in the fact that there's currently sectorial exemptions on certain products like pharmaceuticals and also consumer electronics, that exposure comes down to just about 1% of GDP. So it's quite manageable. So that's the reason why we believe that, even if the 50% tariff was to hold as high, we don't think it will overly impact growth that much, right? Even if it does, it will be more like a one-off hit to near-term growth. But overall, the long-term growth story for India, we believe, remains very healthy.
All right, Mr. Phua, thanks so much for joining at this hour and explaining the rationale for the rating upgrade. But all in all, it is a testimony to India growth story and rising with India. Thank you so much for joining in.
Most welcome.